The strongest argument against Bitcoin right now is it's novel, it's new, and as new, it's not, it's only been around for a number of years, and maybe before I trust my entire life to it, I want to see it around longer. It took 30 years for people to embrace electricity. Bitcoin's been around for 17 years. Maybe it's still early, and I just want to see more people, than me try it out first, and then I'll follow it. So will it take 20 years? Will it take 30 years? Will it take 40 years? The world's full of profound innovations that eventually were embraced by everybody, but it took more than 17 years. And I think the answer is time.
According to Michael Saylor, the strongest case for Bitcoin right now isn't comfort, it's pain. The asset's biggest weakness was never failure. It was the illusion of effortless growth. At just 17 years old, Bitcoin still felt too young and too smooth for people to trust with their savings or legacy. Money is emotional, and when something new rises too quickly, without real adversity, hesitation becomes inevitable. This is why Saylor calls the current collapse essential. The brutal bear market, nearly a 50% slide from the 2025 peak into the $60,000 to $70,000 range, is the kind of pressure Bitcoin needed to prove what it really is. Spot ETF inflows that once symbolized mainstream validation have reversed violently, bleeding billions as institutions retreat. Outlets like MarketWatch track the exodus, while Google search interest hits a 5-year high, showing that fear and curiosity can surge together when an ecosystem is being rebuilt. Yet Saylor insists volatility is not destruction, it is purification. Bitcoin has survived every crash, crackdown, and wave of disbelief, gaining credibility with each cycle. Analysts at ARK Invest argue that beneath the chaos, regulation and infrastructure quietly strengthen, even while the price looks catastrophic. So the real question isn't whether Bitcoin is old enough for trust, it's whether this violent reset was necessary for long-term strength. In a moment like this, is the issue Bitcoin's age, or our refusal to accept that true innovation only matures through brutal, cleansing crashes? Let's take you back to Michael Saylor's explosive interview to gain more insight. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
So, if you got rich in the past decade, you probably bought big tech. You probably bought Apple. You probably bought Google. You probably bought Meta. Maybe you bought Amazon. Maybe you bought NVIDIA. Maybe you bought Tesla. There's no way you got rich without buying big tech. Big tech has been the primary screaming success. The stocks are up 10x, 20x, 30x, 50x. But in all cases, you find examples of the conventional market that underappreciates them and underestimates them. With Apple, it was 7 years through the wilderness. With Amazon, I remember Amazon for something like 4 to 8 years, conventional wisdom was Amazon's an awful company. They'll never make any money. They'll never amount to anything. You almost could have bought Amazon anytime for a decade while conventional investors crapped all over it. And it wasn't until 2020 during the lockdowns that people go, oh, wow, I guess we need Amazon. Mm-hmm. And of course, just this last week, Amazon's revenue surpassed Walmart, and Amazon became the largest company in the world by revenue. But when could you have concluded Amazon was going to work? 2010, 2012. It was already obvious there was going to be no competitor to Amazon. No one could possibly do what they were doing by 2012. 8 years later, conventional wisdom is that. The same is true with Apple. It's like, so Bitcoin, at what point do you have the fundamental ability to conclude that Bitcoin is global digital capital? Now, like what's the indicia? The President of the United States is telling you, right? The head of the Fed, Kevin Warsh, is telling you. The head of the Treasury, Scott Bessent, is telling you. The head of the SEC, the head of the CFTC, 8 other cabinet members, all the Middle Eastern sovereign wealth funds are telling you. BlackRock is telling you, right? My company is 100x its enterprise value, right? When in the history of the capital markets did a company ever buy $55 billion worth of a commodity and then loudly declare that this is digital capital and this is the new money of the world. Okay, so is $1 billion enough? Is $10 billion enough? Is $50 billion enough? Right? At what point do you have enough fundamental insight on this? Well, I would say you had enough to know that Amazon was unstoppable a decade before the world agreed. You had enough insight to know that Apple was unstoppable 7 years before, probably 10 years, actually in 2009, 11 years before the world agreed, you knew it was unstoppable. You have enough information to know that Bitcoin is unstoppable right now. The world's going to eventually come to a consensus, and it'll be the Warren Buffetts and the Carl Icahns of the world that will be what creates that consensus. They won't be first. They'll be last. They won't make a huge amount of money. They'll double or triple their money, right? And they will enter, and the PD goes from 10 to 30. They triple their money in a 12-month time period. And if you're able to think for yourself, and if you're able to weather volatility, you can 10x, 20x, 30x on your investment. But there really is no example of a successful technology investment where you didn't have to weather the 45% drawdown and go through that valley of despair, right? Ours is currently taking 137 days so far. But you know, it might take 2 years, it might take 3 years, it might take 4 years. If it took 7 years, congratulations, it's just like Apple Computer, the biggest success story of the decade. I think the market is evolving. The entire ecosystem is evolving and seasoning. And if you look at all the dynamics, the derivatives market is migrating from offshore to onshore, and it is maturing. And so as derivatives in the U.S. regulated markets grow, that strips some of the volatility off of Bitcoin and some of the upside off of it. It damps the upsides. It also damps the downside. Instead of an 80% drawdown and an 80 vol, you get a 40 or 50% drawdown and a 50 vol. So you're seeing volatility damped on the upside and the downside by the seasoning of the markets. But you also have a situation where the banking establishment is embracing Bitcoin at a progressive but a slower rate than people with short attention spans would like. It'll take the banks 4 years, 5 years, 6 years before they embrace an entirely new asset class. People would like for Bitcoin to be recognized in 4 months. But if the banks take 4 years before they start to bank it, extend credit on it, acknowledge it, and handle it, trade it, custody it, etc., then that means that what you have at the top of the market is $2 trillion worth of Bitcoin, probably $1.8 trillion held by retail investors or offshore investors, and they cannot access the traditional banking system. They're in the shadow banking system. So if you had $1.8 trillion or more than $1 trillion worth of capital and no one would give you a loan on it, then how do you monetize it, right? If I posted $10 million of Apple stock with JP Morgan or Morgan Stanley, I could take a $5 million loan at SOFR plus 50 basis points and I could spend it. But you can't even post $10 million worth of Bitcoin with JP Morgan or Morgan Stanley right now. Therefore, you can't take a loan. Therefore, you have to go to a shadow banking system. You have to go offshore. So how would you actually monetize it? You either have to sell it, right? The safe way is to sell it, but that damps the upside. What else can you do? You can, by the way, you can get loans, a very small amount of loans from a few crypto exchanges where they don't rehypothecate your Bitcoin, but the sum of that capital is a few $1 billion probably. So maybe there's a few $1 billion of Bitcoin credit that you can tap at SOFR plus 500 basis points or SOFR plus 400 basis points. Okay, this not SOFR plus 40, SOFR plus 400. So it's 10 times as expensive to actually draw down capital. And how much capital? 1/1000th of the amount of capital available for securities portfolios. So there's 1% or less of the capital available through the conventional banking system. It's expensive, okay? What else can you do? Well, I guess you can convert the Bitcoin to IBIT. And just in the past 6 months, some banks are starting to extend credit against IBIT, and it's a bit more expansive than Bitcoin credit. It's a bit cheaper, but we're only in the first 12 months. And it's still expensive, and still it's like limited in its loan to value. Now, there's a third place you can get credit. And the third place is you go to a crypto exchange or an OTC exchange, and they'll oftentimes give you a loan at 4% or 3% or 5% or 2%. I've had people offer me Bitcoin-backed credit at 1% or 0%.
If you study the biggest winners of the last decade, a pattern jumps out. The market often doubts transformative technology long before it finally crowns it. The same tension is playing out again. Volatility shakes confidence. Institutions move slower than impatient investors would like. Credit systems are still catching up. But beneath the noise, infrastructure is quietly strengthening. The real edge belongs to those who recognize structural shifts early and can stomach the drawdowns before consensus turns conviction into comfort. There is a reason the price feels heavy at times. The credit system around it is still immature, and shortcuts in leverage can distort supply. Add non-stop global trading and extreme risk-taking, and you get violent swings that shake out the weak. But that chaos also pulls in capital and attention from everywhere. Some people are chasing weekend moves. Others have been building positions for years. The difference is mindset. One trades noise. The other trusts the ARK. Let's watch more clips from the interview.
The catch is they want me to transfer the Bitcoin to them so they can rehypothecate it.
Right.
So if you have $10 million, you either cannot get a loan from a legitimate bank, or you can get a small loan at a 10% interest rate, or you can get a 3 or 4% loan, but then it gets rehypothecated. So your $10 million of Bitcoin gets sold once, gets sold twice, gets sold 3 times. You might actually create $30 or $40 million worth of selling because the Bitcoin that you posted that you transferred to the shadow bank or the crypto exchange rehypothecated it 3 times. Okay, so what's holding down the price? I think what holds down the price of the asset is the lack of a fully formed non-rehypothecating credit system, right? And there's a limit to how much you can rehypothecate certain other assets, right? When you post your home as collateral for a mortgage, the bank doesn't turn around and sell the house on your street 10 times. If they did, the price of houses on your street would be lower, right? So I think that the lack of a fully formed banking system holds the price back. The existence of rehypothecation in the crypto economy damps the vol. It works to both sides, right? When people want to get short, they might get short 50x leverage. When they want to get long, they might get long 50x leverage. So right now we're in that bear market where you've got the rehypothecation holding back the price. And I think at some point it reverses itself. We'll just have to wait. I look at 21 years, and I expect about 29% ARR over the next 21 years. I've always thought that we would have rallies and drawdowns, right? So I see it as a serpentine pattern, where it's just slightly less than 30% over time, but there'll be periods when it will surge and there'll be periods when it will draw down. That doesn't change. I think, if you listen to people, someone will say, well, this weekend there might be some problem in Iran or in the Middle East. And if there is a problem in the Middle East, and if the U.S. does something with regard to Iran, then Bitcoin's the only thing you can sell, and then Bitcoin price may crash, and we're worried about it. And I'll say, Well, if something happens in the Middle East, Bitcoin will be the only thing you can sell. It'll also be the only thing you can buy. And so that just means that a lot of people that want to trade on the weekend are transferring capital to crypto exchanges so that they can either buy or sell, buy, sell, and buy Bitcoin 4 times between Friday at 4 p.m. and Monday morning at 9:30 a.m. And yeah, if you're a trader, what does that make this? It makes it the most interesting asset in the world for you. If you're an investor over 4 years, what the heck difference does it make whether or not it gets bought and sold this weekend? In fact, here's the difference it makes. There's capital, hot money, that's flowing into this ecosystem, into the Bitcoin ecosystem, that otherwise would not be allocated, right? There's a trader, someone's got $20 billion of capital, and their choice is they can either leave it in the bank earning SOFR, or they can put it into the crypto exchange system and they can buy and sell, and maybe they'll make 4% this weekend. Right? When Bitcoin crashes by 5%, there's someone buying while there's someone selling. So people are like, oh, it fell 5%. Well, someone woke up at 4 a.m. on a Sunday morning to buy it at a 5% discount. So someone's going to actually make more money on the weekend than they would make holding conventional money for a year. And that capital is not flowing into New York City real estate. It is not flowing into gold. It is not flowing into conventional derivatives. It's not flowing into NVIDIA stock. It's not flowing into Apple stock. Why? Because you're not buying and you're not panic selling and rage quitting and buying and capitulating and and leaping into the market on these volatility waves. So Bitcoin is most volatile because it's most useful. And, in the US, there's things like Reg T where you can't have more than 2x leverage. Okay, we have laws that prevent you from going to more than 2x leverage. Well, there's no such law, in nature. Right. In nature, like they don't have those laws. You see one centipede and then you see 10,000 ants and it's like 10,000 to 1 and it doesn't seem quite fair. There's nothing fair about nature. If you want to gang up 10,000 to 1 on the centipede, you get to do it. Just like if you want to trade Bitcoin 50x and cross-collateralize it to another yo-yo token, which is 10x, and you want to create a 500x machine, you can do it. There's no one stopping you from doing it. Is it wise? Well, maybe 99 out of 100 times it isn't wise. You get wiped out. But the point is, if that's the case, the people that do stupid things get wiped out, and then in a year, they won't be doing it anymore, will they? Right? Presumably, the people that are trading with 50x cross-collateralized leverage offshore on Saturday morning in response to a Reuters posting, and they're panic selling Bitcoin, and then they're like, oh, well, the world didn't end on Sunday afternoon. Then they're desperately buying it back. Presumably, those people have a reason to do it and they're making money, because if they weren't making money, the free market would separate them from their capital, right? There's no quicker way to go bankrupt, right? Okay. So Bitcoin represents the global capital market, and there are people doing things that you can't do, that you won't do, that you don't choose to do, you don't wish to do, and they're doing it with that asset, and that's what's creating the volatility. But it's also creating the gravitational or the magnetic field, which is attracting all of the energy, all the financial energy of the world is being drawn into this space, all of the political energy, all of the digital energy. It's all being drawn into this space because of that utility. And I think you just got to make your peace with it. Either you're short term and you're a trader. If you're worried about what Bitcoin's going to be in 4 days or 4 weeks or 4 months, you're a trader. Call yourself a trader. And then you better have a trading methodology or trading excellence, or be in the trading business, or be neutrally hedged so it doesn't matter to you. You're either that, or you're an investor, you got a 4-year time horizon, and then it just doesn't matter. All you'd be thinking is, a lot of capital is surging into the space, and a lot of attention is being given to the space that otherwise would not be given to the space because of those crazy traders. And let's just let them do their thing because I'm an investor. I'm holding for the long term.
Open the markets page, and the mood feels heavy. Bitcoin sits in the mid-$64,000 range, down sharply as software stocks tumble and private equity names bleed. The IGV Tech Software ETF hits fresh lows. Headlines frame crypto as just another high-beta extension of risk assets. When equities slip, Bitcoin slips harder. Traders call it correlation. Strategists say it is behaving more like a leveraged tech proxy than digital gold. In moments like this, confidence feels fragile and narratives get tested. But this is exactly the kind of environment that sharpens conviction. The ecosystem is maturing. ETFs exist. Large asset managers are involved. Public companies continue adding to their holdings. Even as short-term flows turn risk-off, capital keeps circling the space. Michael Saylor has argued that volatility is not evidence of weakness, but a byproduct of an emerging global capital market that trades nonstop and absorbs macro stress in real time. Zoom out, and the pattern looks familiar. Transformational assets are misunderstood before they are embraced. Amazon once traded in doubt. Apple endured long stretches of skepticism. Today, Bitcoin is wrestling with correlation, credit fears, and institutional hesitation. The deeper question is whether this is fragility or foundation building. Markets can panic for months. Structural shifts unfold over decades. The price chart shows turbulence. The broader arc suggests something still taking shape. As we wrap up, do you also think today's fear looks like Amazon in 2010 or something different? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to like and subscribe.